The trade conflict between the United States and Canada has now expanded beyond traditional political disagreements. Canada's response to the U.S. tariffs has begun to affect not only the U.S. farming industry, but could also trigger a larger crisis in global agriculture. The situation escalated when the U.S. imposed a 25% tariff on various Canadian goods, including agricultural products like grains, meat, and dairy. Canada quickly retaliated with tariffs of its own on U.S. goods such as corn, soybeans, and beef. This has driven up export costs for U.S. farmers and left them struggling to find new markets for their products. U.S. dairy farmers, who have long relied on Canada as a key trading partner, are now facing serious financial losses. The new tariffs have made dairy exports to Canada prohibitively expensive, cutting demand and lowering prices. As a result, many dairy farms in the U.S. are experiencing major financial crises. Similarly, corn and soybean farmers, who have depended on Canada as one of their largest export markets, are seeing prices plummet, leaving them with unsold crops and substantial losses. Livestock farmers, especially those raising cattle and pigs, are also feeling the pressure as the cost of exporting meat to Canada rises, driving demand down and prices falling. Many of these producers are urgently looking for alternative markets. This trade war isn't just a local problem, it has broader consequences for the economy at local, national, and global levels. The conflict could create a gap in the global agricultural market that countries like China, Mexico, and the European Union might exploit as they increase their own exports, filling the void left by the U.S. and Canada. In the face of these trade uncertainties, many farmers are turning to precision agriculture to increase efficiency. However, these technologies require significant investment, and the financial strain from the tariffs is making it harder for farmers to make such investments. The long-term impact of this dispute could lead to a major reshaping of agricultural practices in both countries. Smaller family-owned farms may be forced to sell to larger corporate farms, accelerating the trend of farm consolidation. Beyond the financial difficulties, farmers are facing increasing emotional stress. With the mounting financial pressure, their mental health is becoming a growing concern. This trade war between the U.S. and Canada could severely damage the U.S. farming sector, but it may also mark a turning point in global agricultural trade. While the immediate impacts are severe, there may also be opportunities for farmers and countries to adapt to new markets and find innovative solutions. The future of agriculture will depend on how these sectors respond to the rapidly shifting trade landscape. As Europe reconsiders its energy strategy due to its dependence on Russia and the U.S., Canada is emerging as a strong alternative. Europe's reliance on Russian natural gas for energy has become increasingly risky due to geopolitical tensions, particularly the crisis in Crimea and the ongoing conflict in Ukraine. While the U.S. is a significant supplier, the cost of liquefied natural gas, LNG, from the U.S. is high, and long-term contracts lack flexibility. This has made Europe look for more stable, cost-effective energy sources, and Canada is quickly becoming an appealing option. Canada's vast natural gas resources, along with its proximity to Europe, make it an ideal supplier. Its cleaner LNG projects are particularly attractive to European nations, pushing for a transition to renewable energy and lower emissions. Canada's strategic location also helps reduce transportation costs, allowing natural gas to be delivered to Europe more quickly and affordably than from the U.S. Unlike the U.S., Canada offers more flexible contracts, allowing European countries to adjust supply according to demand, instead of being locked into rigid multi-year agreements. Canada's growing role in the LNG industry is underscored by major projects like the LNG Canada project in Kitimat, British Columbia, which, when operational in 2025, will be capable of providing up to 2 billion cubic feet of gas per day. Additionally, Canada is developing other LNG projects in regions like Nova Scotia and Quebec, further expanding its export capacity. As Canada rapidly grows its LNG sector, the U.S. is under increasing pressure to rethink its strategies for maintaining market share in Europe. Failure to adapt could result in significant financial losses in LNG export revenues, with Canada attracting attention not just from Europe, but also from major markets like Japan, South Korea, and India. The U.S. must adjust its approach, or risk losing its competitive edge. Even countries like Russia and those in the Middle East are reevaluating their strategies to maintain influence in the global energy market. The question now is whether Canada can rise to become a global LNG powerhouse, and whether the U.S. can adapt to this growing competition. In the context of an energy war, the economy of a country can be transformed in unprecedented ways. Energy disputes, like the one brewing between the U.S. and Canada, have the potential to send gas prices soaring and put immense strain on the U.S. economy. In early 2025, the U.S. imposed a 25% tariff on goods from Canada, citing concerns over issues like illegal immigration and drug trafficking. But Canada isn't sitting idle. In response, they've prepared countermeasures. One of their strongest moves could be cutting energy exports, particularly crude oil, which is vital to the U.S. economy. Such a move would significantly impact the U.S. energy sector, potentially leading to severe shortages in states like Michigan and New York, which depend heavily on oil imports from Canada. Gas prices would spike, and businesses relying on energy would face major financial setbacks. If Canada were to stop importing alcohol from the U.S., it would deal another blow to the U.S. economy. This disruption in the energy supply chain, especially in areas like the Midwest and mountain regions, would send shockwaves through the economy. With rising energy costs, energy-intensive industries would face increased production challenges, affecting workers' wages and business profits alike. The reduction of U.S. oil imports by China is becoming a looming global crisis, affecting not only the U.S. but also Canada. China, one of the largest consumers of U.S. crude oil, has been making significant moves to reduce its reliance on American oil. But why is this shift occurring? Over time, China has reduced its dependence on U.S. crude, opting for cheaper alternatives from countries like Russia, Iran, and Venezuela, nations that the U.S. has imposed sanctions on. This shift allows China to secure lower-cost oil, which makes it a growing competitor to the U.S. in the energy market. In the past year, China's oil imports from the U.S. have sharply declined, leading to a major loss in the American oil market. This drop has a significant impact on U.S. oil export revenues and diminishes the country's standing in the global energy market. At the same time, China is strengthening its energy position by building robust alliances with the BRICS countries, including Russia, Iran, and Venezuela. This strategy enables China to bypass U.S. sanctions and obtain more affordable oil, which bolsters its role as a dominant energy powerhouse on the world stage. Even though these countries are politically isolated, they are more than willing to provide China with cheaper oil, thereby creating a new and influential force in the global energy sector. If this trend continues, will the U.S. face an energy crisis? The answer is likely yes. With China tapping into cheaper oil sources, U.S. oil exports will dwindle, and domestic energy prices could soar, putting immense pressure on the American economy. This will be particularly troubling, as the U.S. is heavily reliant on oil, and U.S. producers could face reduced profits, potentially even job losses within the energy sector. In response, the U.S. will need to adopt stronger strategies. In a surprising move, Canada has shifted its crude oil exports away from the U.S. and directly toward China. This isn't just an economic decision but a political strategy with global implications. The key move here is the expansion of the Trans Mountain Pipeline, with a massive investment of over $24 billion. The pipeline's capacity is expected to triple, from 300,000 barrels per day to 890,000 barrels per day. This expansion will allow Canada to bypass the U.S. and ship oil directly to Asian markets, especially China. Canada's decision to turn toward China is a bold one, considering China's growing demand for energy. This decision presents Canada with an opportunity not only to sell oil, but to forge a long-term strategic partnership with a rising global power. As China heavily invests in oil refining infrastructure and port facilities to accommodate Canadian crude, this goes beyond a mere trade deal. It's a powerful economic and political partnership between two significant global players. But what are the global consequences of this shift? Canada's pivot toward China is reshaping the global balance of power. By choosing China as a strategic partner, Canada is sending a message to the world, potentially creating a ripple effect in international relations. The U.S. is now on the defensive as it faces a realignment in global energy politics. European nations, the Middle East, and oil-producing countries worldwide will need to reassess their trade relationships, no longer relying solely on the U.S., but diversifying their partnerships and renegotiating oil contracts in their favor. For the U.S., losing Canada as a supplier of oil is a significant blow. Canadian crude has historically accounted for about 60% of total U.S. oil imports. This disruption could drive up production costs and create vulnerabilities in the U.S. energy supply chain. The U.S. oil industry, as well as policymakers, will have to make substantial adjustments. Refineries will face higher prices for oil, leading to higher production costs, which could negatively affect energy company profits. The U.S. government will need to find alternative partners or ramp up domestic oil production to mitigate these impacts. To maintain its dominance in the global energy sector, America must rethink its energy strategies, pushing for more flexible policies that involve diverse energy sources from alternative partners. At the same time, Canada is capitalizing on this shift, positioning itself as a strategic partner and a major player in a rapidly evolving global energy landscape. This could signal a turning point in energy politics, completely altering the power dynamics between nations. In addition to the global energy shifts, Canada's actions are part of a broader trend of defiance against U.S. pressures. Tensions between the U.S. and Canada have escalated, particularly after President Trump imposed a 25% tariff on steel and aluminum imports from Canada. This decision not only harms Canadian industries, but also damages the long-standing trade relationship between the neighboring nations. These tariffs have raised concerns over the competitiveness of Canadian businesses and further fueled trade tensions. But the tariff issue is just one aspect of a deeper problem. Trump's controversial comments about Canada's sovereignty, at one point even threatening to annex Canada, have deeply offended many Canadians. In response to this perceived disrespect, the Canadian people have taken a stand, launching a grassroots boycott campaign against U.S. goods and tourism. Canadians are not only reducing their consumption of American products, but are also canceling trips to the U.S., sending a powerful message about their resolve to defend their sovereignty and values. This boycott is having tangible economic consequences. States that rely heavily on Canadian tourism, such as Florida, Texas, and New York, are suffering significant losses in revenue. Estimates suggest that even a modest 10% decrease in Canadian tourism could result in a loss of 140,000 jobs and a $2 billion hit to the U.S. tourism industry. American brands, from Kentucky bourbon to various consumer goods, are also feeling the pinch as Canadians turn to domestic products. The boycott is more than just a protest, it is a symbol of resistance and solidarity. Every consumer decision and cancelled trip is a bold statement that Canada will not yield to U.S. threats. This movement represents a powerful reminder of the importance of national sovereignty and the collective strength of a people united in defense of their values. The economic repercussions of this boycott, coupled with Canada's strategic energy shift, are setting the stage for a major reordering of global trade relationships. Canada's bold stance challenges not just U.S. policies but the broader geopolitical order, signaling a possible turning point in how nations engage with one another in the global energy market. This is not just a trade war, it is a fight for respect, sovereignty, and the future of international relations. The question now is whether the U.S. will adapt to these shifts, or continue down a path that risks diminishing its role as a global superpower. As Canada strengthens its energy ties with China, it is clear that the world is changing, and countries must be prepared to navigate this new reality.